Hey guys, before we get started with the market update, let me direct your attention real quick to our end of year super sale. We're going to offer RepliQuants Unlimited, which is our options offering. It usually goes for $149 per month, but during the month of December, you can now lock in an entire year of uninterrupted access to RepliQuants Unlimited, our premier service, for only $1,200. That's a massive discount. But wait, it gets even better. For limited time only, we now offer you lifetime premier access for only $1,800. That's right, never pay us a single cent again, and enjoy our signal service, all our quant tools, our growing library of educational content, our market updates, and much more. Enjoy all that for the remainder of your natural or unnatural life. That's a once-in-a-lifetime offer, and I don't expect it to ever come back, so grab your membership now while this special offer lasts. Simply go to repliquants.com/super sale. That's repliquants.com/super sale. Welcome back. It's Mike with RepliQuants. It's Tuesday, December 13th, 2022. It is quadruple witching week. And in case you didn't know what this means, it's when index futures, stock index options, stock options, of course, and single stock futures derivatives, which you can kind of forget about, they all expire. Things go wild. And on top of it, we also have the PPI print. Now, if you look right here, if you type in ES for the ES futures, you see it right here. That's December contract, which expires on the 16th. And of course, we also have the options for it right here, these two contracts. Plus, of course, we have something like the spiders, index options right here on the 16th as well, expiring, and so on. So plenty of stuff that's expiring this week. A lot of volatility almost baked in the cake. And well, the market is pricing it in. Now, also what's happening right now, just a little while ago, the producer price index came out. It was slightly less horrible than anticipated. And the market is going wild. So if you go over here on the ES, let's check it out. And check out the hourly chart, and you can see that we're just ramping already. There's a little bit of a pullback, but that's to be anticipated. Now, I ask you, how do you really prepare for that? Now, if you look here at the daily chart of the spiders, I've also put up the implied volatility Z-score right here on the bottom, so it gives you an idea of how implied volatility is ranking. It's been very low, and it's jumping up a little bit, but still, as you can tell already by the expected move ranges, it's been compressing and compressing, which is just wild in itself, considering what's going on in the marketplace and, well, the macroeconomic situation as well. We've seen big moves all over the place, and, well, we just see smaller and smaller ranges here, an expected move, which is, well, I would call it concerning, because it's very difficult this way to handicap risk. So right here, this jump that we're seeing, there's no doubt in my mind that at some point today, we're probably going to bust above the expected move again. So question always is, why is the EM range, the expected move range, why is 1 standard deviation of price movement being handicapped so poorly? And it continues to happen. I mean, we see it last week as well, right? We dropped right away, and then we actually closed outside. Nevertheless, we're seeing these small ranges. So a very complacent market environment, which doesn't make me feel at all warm and fluffy. Now, I feel that everyone seems to be anticipating the Santa rally. Well, we're kind of in the middle of it, and we haven't really gone anywhere. Today's already the 13th. How many more days before everyone is just taken off for the year? It's been a terrible year for a lot of people, and I think a lot of the people are just very much looking forward to just kind of take a week or two off and not to think about the market at all. Given this, I really wonder what the upside potential here is in comparison with the downside potential. I've made this point for a while now. We seem to be working our way up and down here. And, well, if you're looking at the daily candles, they don't really reflect fully what's going intraday with these huge jumps in between. And it's really hard to handicap that type of risk, especially if expected move is so poorly priced. If you look, for instance, at the VIX, right here, last time when I posted a market update, we were somewhere around here, and I was already posing that this is probably as low as we're going to go. And I kind of regret not loading up on more downside protection down here, which might sound weird given that the market is actually going up. But this actually was a very good price point in terms of implied volatility. But I still feel with this right now here, and also where we're probably heading, we're going to get a second or even third chance to load up on downside protection. And I'm particularly referring here to my CYA spread that I've talked about many times. If I want to go out here a little bit further, okay, what we got here, 3 years, okay, 5 years, that's a bit much. There you go. 3 years, 1 day, okay? Give you a little bit more context. And, well, no, we're not seeing these huge spikes right now, right? That's basically right here, early 2020. You know what was happening then. And since then, we worked our way down here, and then we started again. I've talked about this last time. Building in mid-2021, we started building this megaphone pattern. But lately, right, if you're looking here, it's always very difficult to predict how high things will spike on the VIX because it's not normally distributed. And it's much easier to take a baseline on the bottom and plot forward. And as you can see, we actually dropped below it, and the odds for a reversal here were actually quite low. I was looking forward to potentially even grabbing some exposure down here. Didn't happen. Maybe we're going to get another chance. Maybe things will go actually that low. That would be really awesome. So what I'm looking forward to is potentially grabbing a whole bunch of my CYA spreads. In case you wonder, my CYA spread is actually a variation of the put ratio back spread. There is another leg further out, far out of the money, in order to offset some of the skew that happens when we see big movements. We've experimented around a lot with that, and that seems to be the most optimum strategy if you don't want to hold naked puts, which I always vote against, because you're just going to be killed by theta decay, because timing these things is almost impossible. So the whole idea is to start bulking up on those somewhere around here if we drop this low, because if you're looking at the range over the last year, we've barely spent any time below 20 even. 19 just once actually. And if we're actually dropping below here, the odds of a jump higher they are really high. If you look at the VVIX as well, I talk about this one a lot. Most people don't look at this one. It's actually the volatility of implied volatility. And what does it mean? Well, let's just say above 110, we are entering the VOMA zone. And VOMA is another Greek, basically, that it's to Vega what gamma is to delta, if that makes any sense. You can look it up online, read up on VOMA, and it probably makes sense to you. But in general, without even having an understanding of the ranges and the implications of what particular ranges mean to the marketplace, just look at this. And then potentially go out and look at a max, okay? See how far we can go on this one. How low can you go? And right here, I mean, look at this, right? This is all the way back to 2013. I wish we had more data. But let me just tell you that even these readings down here are fairly rare. We've already jumped up a little bit, and I wasn't surprised. See this baseline I painted here? And I told you that a few weeks ago already. Keep an eye on this. And, somewhere right now we are jumping up a little bit. And I think if you are looking for the market to really move in a major way, the point where things really become unglued are going to be, let me go back out here to daily. Well, actually, let me go back a little bit. Okay, 1 year, 2 years, there you go. Give a little bit more context. We're somewhere in the middle right now from these really low readings, and above 110 is when things are going to get really volatile, super volatile. This is where market makers in particular are paying great attention to. It's basically marks the beginning of the VOMA zone. And that is really where market makers specifically are realizing that things are becoming unglued. Also look at things like, for example, let me pull this up real quick here. Let me just go, by the way, if you're subscribers, you can just go to repliquants.com and then you can go to IVTS, that's implied volatility term structure. Let's load it up and see where we are. Okay, so this is really interesting. This is basically the 3 months VIX, which originally was called the VXV. I still call it like that because I'm an old dinosaur. But now it's called the VIX 3M, right? It's basically a 3-month VIX. And against the VIX, see this jump here? This doesn't sound like much, but this is actually massive. right? There's actually quite a massive jump here. And this, for me here, the 0.95 line is a threshold. In the olden days, right, which means, well, until about mid-2000, well, okay, let's call it, yeah, mid-2020 about. This was the point after which I did not want to trade expected move anymore. Okay, this is basically when things become very, very complicated in terms of managing risk. For example, if you're looking at expected move and you place a butterfly, let's say we have something like, there's the market opening. So, for example, let's draw a distribution, normal distribution, right? Something like this. Okay, let's say that this about is one standard deviation, right? What does that mean? Well, about 67.x% that price will remain in this range, right? If we're here right now, this means that from here to here, and from here to here, that's about the range. So if it's 20 handles, let's say it's 20 handles, that means that it's 20 up and 20 down. Makes sense, right? So when volatility is within a certain range and when the IVTS, basically the delta between right here, the VIX and the VXV, the VIX 3M, the 3-month VIX, if that delta deviates, then we're in a range up here where trading, for instance, placing a butterfly right here or placing a butterfly down here, have very low odds of succeeding. So you want to stay below here, about actually 0.92. Statistically, that is the threshold after which I do not want to trade these type of strategies. Now, I haven't really over the last year because things are just so unglued and volatility has gone crazy. But even in this environment, when I see two things happening. First, we see a big spike above 0.95. Second, we see a large delta from the baseline. This is a baseline, right, that we're calculating. And the baseline usually is where we see mean reversion. So with this spike right here, admittedly, there are very high odds that we're going to see a reversal. Let me redraw this right here. Okay, one more time. So we're here right now. The baseline is here right now. So most likely within a day or two, we're going to see a reversal down. However, one, we spiked all the way to here. Two, we're seeing a big delta between those two. So there will be normalization happening. There will be mean reversion. So that means we see a lot of price movement. And as you can imagine, when this happens, it's very difficult to place any type of strategy that is based on expected move. That's based on one or even two standard deviations, because things can just go all over the place and there's no plotting forward. Okay, so coming back to the marketplace right here, let's look at the SPX. Where are we right now? We are, as you can tell, slightly above the channel. And that puts us again into a situation where a reversal becomes very, very likely, unless, let me draw this right here, we see a jump to above, somewhere in here. Technically speaking, even a jump above, okay, come on, right here. So even a jump above this probably raises the odds because we have a little bit of resistance here. So we're now heading into a territory where as we cross over these spike highs here, well, we're kind of bucking the trend, so to say. The trend has been down and it's been a high volatility downtrend, which is very difficult and very dangerous market environment for any trader, even the most experienced. And so in this market environment, well, it is really hard to survive if you trade on a directional basis. Now, if we, however, breaching above this, there are very high odds of a bear market rally and they can be very violent. What I'm talking about here, I'm talking about potentially a push all the way to 4,500, somewhere in here. It's possible, but there are hurdles that have to be overcome. I think 4,200 is probably the first one. I'm just rounding up numbers here. 4,200 is probably the first one. And I think the odds of a breach above here, well, it's possible, right? It's possible. The Fed would have to come out tomorrow, because we have on the roster, if you're looking at the calendar here, tomorrow, again, FOMC, right? Economic projections, it's FOMC week, monetary policy statement, and of course the interest rate decisions. So anything can happen. It's going to be a wild week, a lot going on. So we had the PPI print, we have Fed week, we have quadruple witching, really everything is going on. And directional trading in this environment is really tantamount to coin flipping. Because again, as I said, let's go back to the short-term chart here again. All right, and let's go here, the price hourly. It's just really a market that is purely data-driven. It's purely data-driven. Economic reality has lost all meaning. And in a data-dependent market like this, anything can happen at any time. And I would caution anyone against direction trading in this environment. Things are becoming unglued, and it's not getting any easier also moving forward, because after this Christmas rally, we're looking statistically at a very wild January. And January, normally, there's a little bit normalization that is returning to the marketplace. All right, let's go back a little bit here and go to, let's see, 3 years, 1 day. That sounds good. Okay, so this is where we've been all year. And it's been a rough year, okay? Kind of just to take stock of where we came from, right? This has been 2021, by all intents and purposes. Very, very good year. 2020 was a wild year as well, but at least it was more directional. I mean, look at this, right? Just think about this for a second. Yes, this was a wild market, but if you think about it, after, let me draw some lines here, let me grab my pen again, okay? So after we reached this, didn't mean this tool, but okay, good enough, right? After we reached this point right here, the odds of continuation lower were pretty high, right? And of course, picking the lowest tick right here is always very difficult. But again, after reaching this threshold, after breaching through this spike high here, things were fairly directional, right? All the way into here even, right? Things got a bit more wild here. But where have we been this year? I mean, this is Dr. Zhu's worst nightmare. And frankly speaking, I don't think it's going to get any better moving forward. Even if we're jumping all the way up to here, what do you feel is going to happen afterwards? Because we're not just going to return to this here. These days are over. We're looking at a hell of a lot volatility moving forward and big moves to each side. And my point again being that directional trading is dead in this environment. You have to really look at other factors, which are playing on time, playing on volatility. Volatility we have plenty of, and we can use that to advantage, especially if we are in this environment. I mean, what I just showed you here with the SPX, and we're trading this low on the implied volatility scale. This is a huge opportunity, I feel, that I will seek to exploit, especially if we're dropping a little bit lower here. Okay, so let's see what happens. Okay, that's all I got for today. See you guys next time.